Okay, let's dive right into this, because today we're looking past all those terrifying news headlines to see how financial markets actually react to global shocks. Welcome to The Explainer. When a major conflict erupts, it is so incredibly easy to let fear just take the wheel. But as we're going to see, historical data completely defies our basic instincts.
It's the ultimate question, isn't it? What actually happens to your money when the world goes to war? Look, our immediate, deeply human instinct is to just panic. We want to sell everything, retreat entirely to cash, and basically hide under a rock until the dust settles. It feels like the safest move. But here is the secret we're unpacking today. Over 110 years of historical, mathematically proven data tells a completely different story. The reality of how Wall Street responds to wartime is absolutely going to change the way you look at your portfolio forever.
Section 1. The 1990 Gulf War Shock.
To truly understand this, we need a foundational case study. Let's travel back to the summer of 1990. On August 2nd, Iraq suddenly invaded Kuwait. And man, the markets instantly panicked. Why? Well, Kuwait's oil fields were seized, and the price of crude oil literally doubled overnight, shooting from $17 to $36 a barrel. The uncertainty was just suffocating. But then, look at the middle of this timeline. In January 1991, the U.S. and its allies launched Operation Desert Storm. Once the actual military action began, once the uncertainty was replaced by definitive action, the markets violently rallied. By the end of 1991, the stock market had completely recovered, and then some.
Now, what's really interesting about this is that massive negative 21% figure. This represents the peak-to-trough drop of the S&P 500 during those initial months of the Gulf War. I want to point this out just to validate the fear that investors feel during a crisis. A 21% drop is massive. It's terrifying. It's exactly the kind of number that makes a rational person want to liquidate their entire retirement account.
But here is the narrative whiplash. If you had given in to that fear and sold at the bottom, you would have completely missed the massive 29% rebound the S&P 500 experienced by the end of 1991. The market actually finished the year significantly higher than before the crisis even started. This mathematically proves that panic selling at the bottom of a geopolitical shock is consistently, predictably costly.
Section 2. Anatomy of a Market Panic. Zooming out from the Gulf War to a macro-level dataset, we see a truly remarkable consistency in market behavior. We're looking at some of the most terrifying, world-altering surprise attacks in modern history here. Pearl Harbor in 1941 triggered an 11.6% drop, but the market recovered in just 31 days. The Cuban Missile Crisis, literally the brink of global nuclear war, saw a 6.3% drop and a shockingly short 13-day recovery. Even the 2019 drone strikes on Saudi Aramco, which temporarily crippled global oil supplies, only caused a 4.9% dip that completely erased itself in 41 days. Markets stabilize with astonishing speed.
So the absolutely crucial point is this, negative 5%. According to data looking at over 20 major geopolitical shocks since 1941, the average total drawdown is just negative 5%, and it takes an average of only 47 days for the market to fully recover. Let that sink in for a second. The chaos on your television screen rarely matches the actual, calculated resilience of the financial markets.
In fact, if we look at Acadian Asset Management's massive data set of over 2,600 unexpected global events, we see a clear directive. 12 months after a major shock, the S&P 500 is higher 68% of the time, delivering a median return of 8.4%. The initial evidence, proven across decades and continents, suggests that unless you somehow have some incredible insider view, the most effective, mathematically sound strategy is to simply stay the course.
Section 3. The Hidden Oil Factor.
You see, not all conflicts are created equal. There's a hidden nuance behind which wars cause slight dips and which cause actual crashes. Let's impartially compare these two Middle Eastern conflicts side by side. On the left, our 1990 Gulf War example. Oil doubled and the market dropped 21%. Now on the right, the 2003 Iraq War. In 2003, oil prices actually fell from their pre-war highs, and as a result, the market gained a staggering 26.7% in the first 12 months of the conflict. This reveals the hidden factor. Markets don't sell off purely because of military violence. They sell off because of threats to macroeconomic fundamentals. When war provides geopolitical certainty without an oil shock, markets rally. Energy prices are the true driver of wartime market panic. Why? Because oil acts as a direct transmission mechanism for inflation. It instantly reduces consumer affordability right at the gas pump, draining money from the rest of the economy. And it dramatically shifts corporate profit margins because shipping and manufacturing suddenly cost a whole lot more. This is exactly what happened during the 1973 Yom Kippur War, which is the big historical outlier here. In 1973, an oil embargo physically withheld supply for months, quadrupling prices and triggering a devastating multi-year bear market. It's the oil, not the armies, that Wall Street is watching.
Section 4. The Wartime Volatility Paradox.
And this brilliantly illustrates a twist in the data that pretty much defies all common sense: the wartime volatility paradox. Believe it or not, stock market volatility is mathematically lower during wartime than it is during peacetime. No way, right? How is that even possible? Well, think about what happens during a major war. The government steps in with massive defense spending. They create guaranteed corporate contracts. Factories suddenly have these massive guaranteed backlogs. This effectively eliminates the very economic uncertainty, that lingering question of what will demand look like next quarter that usually drives market volatility in the first place.
A massive study from the National Bureau of Economic Research cements this paradox perfectly. They found that, quote, market volatility is meaningfully lower during wartime. Once the government is writing the contracts, earnings become predictable. Wartime economies, oddly enough, often run with much more predictability than normal peacetime economic cycles.
And hey, we see this resilience globally, too. Studies on Southeast Asian emerging markets confirm that geopolitical risk actually plays a stabilizing role over time. When a shock hits, investors swiftly adjust, rebalance their portfolios, and move toward defensive certainty. The market absorbs the shock rapidly, resetting expectations and often setting the stage for positive future returns as the region adapts to the new normal.
Section 5. The Smart Investor's Playbook.
So, armed with all this historical data from the Gulf War to global emerging markets, how do we actually apply this today? Let's look at a very recent real-world application. In February 2026, amid strikes between the US, Israel, and Iran, oil prices nearly doubled to $110 a barrel, and the Strait of Hormuz was effectively closed. The news headlines? Apocalyptic. Yet the stock market absorbed the shock perfectly in line with historical averages. The S&P 500 largely remained flat and range-bound, transitioning from an initial shock to a measured equilibrium. Wall Street literally looked past the headlines to focus on resilient corporate earnings.
Let's move to and see how this builds our 4 golden rules of the Smart Investor's Playbook. First up, never panic sell on the headline. The media sells fear, but markets trade on fundamentals. Second, rationally expect a temporary 5% market dip. It's normal and it's historical. Third, watch oil and energy fundamentals, because that is where the real economic threat lies. And finally, stay invested for the 12-month rebound. Remember, long-term returns are driven by corporate earnings and innovation, not geopolitical headlines.
So, I'll leave you with this final thought to consider. The next time a geopolitical crisis hits the news and the talking heads are screaming that the sky is falling, are you gonna trade on fear, or will you trust a century of proven market resilience? The data is crystal clear. The choice of how to use it, well, that's entirely yours. Thanks for joining me on this explainer. Keep learning, and I'll see you next time.